Hello everyone, my name is THUòng and today we have a special topic about 1031 exchange. Today we have Ron Ricard. Welcome Ron.
Thank you.
And Ron is Vice President and Regional Account Manager for IPX 1031 Exchange Northern California, Bay Area. And Ron has over 20 years experience in just 1031 exchange. So it's our honor to have you here today, Ron.
Thank you very much for having me, Tránh.
Thank you. So please tell us, what is 1031 exchange?
Well, thank you for having me, Tránh. 1031 is just the part of the tax code that allows you to sell investment real estate, buy replacement investment real estate, and as long as you follow the rules, you get to defer or delay paying taxes on the profit that you make.
Okay.
So you go through the regular process of selling the property. At the close of escrow, the money comes to a third party called the intermediary, that's us, and then we send the money to the title company for them to buy the new building. So they sell something, they buy something, they don't touch the money, and by doing that, they get to defer paying taxes.
So we're trying to emphasize the word defer.
Correct.
Because a lot of people misunderstanding this is tax-free. You know, it's like, don't use the word tax-free because it's just defer that tax, capital gain tax.
Correct.
Until you keep rolling it until basically you die, or until you sell the last one and you're not exchanging anymore, then you have to pay tax on it.
That's correct. So if you sell it, while you're alive, then you end up paying taxes on the profit that you've made at that point.
And accumulating all over
that's correct.
The years or the transactions that you
every time you do an exchange, you make more profit. That gets all added up. But the good news is that when you die, well, that's not good. But when you die, all the capital gain disappears.
Yep.
And whoever inherits it from you, they have no taxes to pay. So that's the real beauty of the 1031.
Okay.
That's why most people do it, so that they never have to pay the taxes.
Awesome. So that is the main purpose of 1031, not just borrow it for a while and then sell it the last one. You still have to repay the whole capital gain for the last few transactions that or whatever transaction you made before that.
That's correct. But even if you know you're going to pay the taxes in a few years, you know, if I can avoid paying $100,000 of taxes now and use that money to build my real estate, so that if I pay it in 5 years or 10 years, I've made more money because I was able to defer those taxes more and more. So you're able to. So even if you're going to pay the taxes eventually, it's still worth doing the exchange.
Okay, because you borrow the tax money that you're supposed to pay and just use it to invest.
It's like getting an interest-free, no-payment loan.
Yeah. That's awesome too.
Yeah.
That's great. And so what is the process? If I want to do a 1031, what should I do? And what's the steps? Okay.
Well, the first thing I always want to make sure is that you understand what the rules are of the 1031, because there are some very specific rules. But the process itself is fairly simple. You're going to go sell a property. Let's say you're going to sell this building that we're in right now. You're going to list the property just with one of our great real estate agents here, and ultimately you'll find a buyer for the property. You'll open escrow at the title company. That's when we get involved. We work with the title company. There are some agreements that need to be prepared, but when escrow closes on the sale of this building, that's when the money comes to us, and then the fun part starts. You have a very strict clock. You need to know what you're going to buy within 45 days from when escrow closes. You need to know what you're going to buy within 45 days, though you have 180 days, almost 6 months, to actually close the escrow. But for most of us, that 45-day clock is the critical one. So you need to really be in a firm contract by that 45 days so that you know exactly what you're going to purchase.
Can I clarify the 180 days? It means that the clock start, the 180 days is from the day you close escrow for the sales as well, not from the day that you identify the property.
That's correct. Both the 45-day clock and 180-day clock start the day escrow closes.
Okay.
Now, one thing we're seeing in today's market is we're seeing a lot of people have longer escrows, so that if it helps them, it gives them more time before escrow closes, so it gives them more time before the 45-day clock starts. That way, that just gives them more time to find a replacement property. But especially when we're dealing with commercial real estate, it's easy, it's not like residential. Everyone wants to close in 21 days or 30 days. Commercial real estate usually has much longer escrow, so that actually works to your advantage when you're doing an exchange. That hopefully gives you more time to find a replacement property.
But there's no special treatment if you do the exchange for commercial or residential. The date is still the same.
The process is the same. It's any kind of investment real estate for any other kind of investment real estate. So you can sell commercial to buy residential. You can sell farmland and buy apartment buildings. But the rules are the same no matter what. But it does need to be investment real estate for investment real estate.
Okay.
There are always three kind of main things to talk about. The first one is that 45-day clock, which is very important. I can't emphasize that enough. The second is you can buy, again, any kind of real estate. Also anywhere in the country. You can sell in California, buy in Texas, buy in Hawaii. It has to be within the United States, but it can be anywhere in the United States. And even if you buy in different states, you're still deferring both state and federal taxes, which is nice. The third thing, which is also where most people make a mistake, is you need to buy equal or greater in value to what you are selling. So if you sell a property for $1 million, you need to buy at least $1 million worth of replacement property. You can add up to many properties, 100 properties, to make up that $1 million. And you could buy more. You can sell for $1 million, buy for $10 million if you want. But if you want to buy less, then that's okay, but you pay tax on the difference. That's called boot. So if you want to sell for $1 million, but you only find something for $800,000, you pay tax on that $200,000 difference. But the key is you are buying equal or greater to what you are selling the property for. Not the profit, not the equity, everything.
Okay. That's something a lot of people misunderstand too. They think only the profit that
Correct.
you need to move over. It's like, no, the whole value, whatever you sell for.
Exactly, and that's exactly right. Most people think you only have to reinvest the profit, but that's not true. What's called your basis, that's the amount you have invested in the property. Those are the first dollars that get moved over into the next property. That's why you have to reinvest everything.
Okay. The cost of doing an exchange
is very small, actually.
Okay.
It's for our fee currently is $950 when you sell the property, and $250 for each additional property that you sell or buy. So it's if you're just selling
per transaction? It doesn't matter how much the value is.
It doesn't matter. For us, there's paperwork. Whether the property is 100,000 or 100 million, the paperwork is exactly the same. So the fees really don't change. So it is a flat fee, and it's not very much. So if you're just selling one, buying one,
very small fee for what you can save over capital gain tax.
Most people who say that, they say that's all. You're saving me all this money in taxes. I just take a little bit.
And that's awesome. How about reverse exchange? Can we buy first and then sell?
Yes, there is a way to do that. Now, the vast majority of our exchanges, you are selling and then buying. And you're taking the money from the sale, and that money goes into the property you're buying. However, there is a way to buy first and then sell. That is called a reverse exchange. And we have an entire division, that's all they do. The key about the reverse exchange is this is a much more expensive transaction. So now when we're talking reverse exchanges, now we're talking $8,000 to $15,000. So it is much more than a regular exchange, but it's also much more complicated. So what you would do in most reverse exchanges is you can't buy that new property, because if you buy that new property, you now own both of them. And if you own both of them, you can't exchange into something you already own. So in a reverse exchange, we actually take title to the property. Normally, we take title to the property you're buying. So you come into escrow to buy that new property. We create an LLC and take title to that property. So now you haven't actually done your exchange yet. You haven't sold anything yet. But we're just on title as like a placeholder. Now, while we're on title, we lease the property to you, so you're still taking care of it, you're still managing it, you're still collecting the rents, but you then have 180 days, just like a regular exchange. You have 6 months, 180 days to then sell your property. And then when you sell your property, we just give you the new property. And that actually becomes your exchange at the very end. You sold your property and you acquire the new property from us as the replacement.
And what about the capital or the money to buy that exchange property.
You better be rich.
So we have to buy. That person has to buy that property in advance. Let you hold the title and then do the exchange. So you have to have money up front.
That's far and away the biggest issue with reverse exchanges, because normally you're just using the money you're just using the money from your sale, and sometimes you can do an exchange with almost no fee at all, I mean no cost at all, or no money out of your pocket, because all the money from what you sell goes into what you buy. But in a reverse exchange, you have to be able to front that money. Now, and getting a loan is a little bit tricky. Commercial loans are actually easier to get than residential loans when it comes to reverse exchanges. But we have clients, sometimes they just write a check for $5 million to go buy a property from their own bank. No problem, makes it very easy. But that's the key. You do have to have the money to be able to buy that property between your funds and a loan to be able to buy it. And then ultimately, once you sell your property, then yes, you get that money back, but you need to be able to bridge that money yourself.
And with all the paperwork and the LLC title holding and all that, that's why the cost exchange is what, 18,000?
It's between 8 and 15,000.
8 to 15.
Yeah.
Okay.
Depending on it does depend on the value of the property. If there are loans involved, there are a few things that factor into that. But it also takes longer to set up. Whereas we can do a regular exchange in less than a day, a reverse exchange is going to take about 2 weeks to set up. So it's a more involved process.
Depreciation deduction. It's like if I sold a property, a single family home, and I deduct 10 years of appreciation on it, and the next property I only have 17 and a half years left.
Right.
That is something that very new to me. So can you please explain to the audience?
So let's start with, in general, what depreciation is. Depreciation is essentially you get a tax write-off every year based on the value of the improvements on your property. If you just own bare land, there's no depreciation because there's no improvement. But if you buy the land and the building on it, you get to depreciate that building. If it's residential real estate, including apartment buildings, it's depreciated over 27 years. If it's commercial real estate, like shopping centers or office buildings, then it's depreciated over 39 years. But the key is you have a property, let's say, make it simple, you bought a property for $1 million, and the accountant says, well, the land is worth 400 and the building is worth 600. So, and let's assume it's residential for right now. So you take that 600,000, divide that by 27 and a half, and every year you get that amount of deduction. So what that does is, that $1 million that you bought the property for, your basis goes down every year a little bit because of that depreciation. Now, the thing to remember though, when you're doing an exchange, is you are deferring both the depreciation as well as the capital gain. So if if the property that you bought for $1 million, you now sell for $2 million, and you now go buy another property for $2 million, you don't have to pay that depreciation or the capital gain. But in answer to your question, yes. So when you do that exchange, let's say you sell for $2 million and buy for $2 million, you have no new investment, but you get to take the rest of the depreciation. So if 10 years in you've depreciated this much and you have 17 years left, you'll have 70, right.
Or commercial, let's say 39 years and you did 10 years, you only have 29 years left.
Right. Now, but the good news is though, let's say when you do an exchange, you sell for $2 million, but you buy for $3 million. Now you have $1 million of new investment. So on the first property, you may only have 17 or 29 years left, but now you have a new depreciation stream for that extra $1 million.
That starts the clock. That
starts the clock again just for that extra $1 million.
Oh, but so for that difference,
right?
$1 million. Now you start. Let's say commercial. You start from zero, 39 years.
Exactly.
Okay.
And so the important thing to realize is that on the same property, you will have different depreciation schedules for different things. Wow. Maybe you did a remodel to the property. That's going to give you new depreciation also starting that year. This is also why you need a very good accountant when you own real estate. When you have when we're talking about having a good accountant, one of the reasons is when you do an exchange, it's not like 5 years from now you have to say, oh, I did an exchange back in 2022, what happened? Because your basis and your depreciation and your gain, all of that is rolled forward into the next property. Yeah. So when it starts, that new property, when you do the exchange, it already has that appreciation. It already has the gain in there. It has all those numbers already. So you don't have to create something new every time you want to look back what you did in the past. Every year it already rolls forward. And again, this is how an accountant is very useful.
Okay, thank you, Ron. I think that pretty much capture all the questions we have for 1031 exchange.
Very good.
So thank you so much, Ron, for joining us today, and thank you for watching, everyone.